Right, good evening, everyone. Thank you very much for joining this webinar tonight. We've actually got, I think, 65 people registered from 12 different countries. So I guess good evening, good afternoon, good morning, good night, depending on where you are. I'll just give everyone a minute or so to log in. I know sometimes it takes a while. I think maybe what would be good, just while we're waiting for people to join us, perhaps I'll just say a few words, I guess, in the introduction. So thank you very much to CGWM, Canaccord Genuity Wealth Management, who are going to be providing the content for this evening. I've actually been using and following their strategies and funds, and we've been using them as a firm since I joined IPP in 2008. They were actually Colin Stewart back then. But they very quickly became one of the core strategies that we used for our clients. And actually, in the last couple of years, it's not just been the Opportunity Fund, but we've also started using the Diversity Fund as well. So I think many of you who are viewing this tonight are already investors. Some are perhaps considering to be so. But I thought it might just be useful in reflection, I guess, from last year, 2020. I won't talk too much about COVID and all that. I think we all remember COVID, and it's still obviously all around us, and lockdowns, etc. But for investing, perhaps the most notable for last year was actually the fastest ever bear market in the history of the stock market. It was just 16 days, which is amazing. It was actually also, it didn't stop there, it was the fastest ever 30% decline from its peak of the S&P 500 in just 22 days. So that beat the previous three, which were all during the Great Depression era. So, a long time ago, and a, well, really pretty bad economic climate around the world. So, IPP saw some opportunity there. We actually increased all of our risk profiles. We increased the equity recommendation across all risk profiles on the 16th of March, which was just 1 week from the bottom. And CGWM also, with their Opportunity Fund and the cash mandate, if I'm not wrong, I think they were up to 20, maybe even above 20% at some point around this time last year, and actually used that money to buy cheaper positions and reduced that cash holding to less than 10% before the year finished. So, I think we've both proven to sort of help navigate the markets, and it is tricky. Last year, actually, after all of that, the MSCI World ended up positive, plus 15%. But what's pleasing is that Opportunity beat it, and it was over 17% return, and actually with less volatility. Diversity, which is the more balanced managed strategy, still did 14%, and the volatility was only 9%, which is really quite impressive. And I think this is one of the key reasons why we use CGWM as a core holding, and why we will continue to use it. I'll now pass over to Nick Teo, who's the Business Development Director for CGWM. He's going to say a few words and introduce our speaker tonight. Thank you.
So good evening, everyone. Can you hear me well? So my name is Nick. I'm actually based in Singapore. So CGWM is a company that's we are based in UK. We have office in Guernsey. In fact, actually, Justin Oliver is based in Guernsey, but because there's a lockdown today, he's at home. So we are very pleased to work in conjunction with Ian and EAG, IPP. We are very happy that they invited us to be part of this investment talk, this market review. And also at the same time, just quickly want to mention that our funds are actually available through the live companies like Friends Provident, Utmost, Tokyo Marine as well. So if you like our funds, please go through Ian and his team and access our funds. So without spending too much time introducing myself, we can spend some time later on in future, because I'm based in Singapore. If you ever do need to know more about CGWM, drop me an email or WhatsApp, and then we can share more about our company and what we do. So without further ado, let's invite Justin Oliver. Justin is our Deputy CIO. He works very closely with the CIO of our company in all aspects of investments. So thank you, Justin.
Thanks very much, Nick. Thank you, Ian, and thank you to you all for taking the time to listen to us this afternoon or this evening, depending on where you are in the world. What we wanted to try and do today is just give you an outline in terms of our thinking, in terms of the coronavirus, the impact on the global economy, and perhaps most importantly, how we think that financial markets will develop over the course of 2021, and the sort of changes that we're contemplating making within the funds. Now, clearly the title of this presentation is navigating a post-pandemic world. I don't want to leave you with the impression that we're suddenly expecting that one day in 2021 that we'll wake up and everything will be back to the way we might have lived our lives in 2019. The process that we're going through at this moment in time is one of continued recovery, of a continuous vaccine rollout across the world. So again, it's going to be a slow sort of evolving process as far as that's concerned. But again, financial markets are already starting to discount the recovery which we're starting to see. And again, going back to Ian's point at the very beginning, talking about the markets and the sharp falls that we saw and the subsequent recovery. Again, in some aspects, financial markets have already looked through and we're looking through to 2021 last year. But I think if there's one key message that we want to leave with you today, is that certain areas and certain sectors performed very well in 2020. So US stock market and technology in particular. I think with the way the world is developing, it is reasonable to expect that some of those previous winners won't necessarily continue to lead financial markets. And actually, we might see a rotation into other areas, and previous laggards might start to take up the mantle of stock market outperformance. So hopefully we'll sort of touch on those on the next 20 to 25 minutes. Again, as sort of Ian highlighted, coronavirus, we know all about that. It's clearly still in the news. So there's very little we can say here that you won't have already picked up, except that clearly it's still a serious and ongoing situation. The number of deaths around the world is now well in excess of 2 million, sadly. And again, whilst there's been a slight fall off in terms of the number of new daily cases, the number of cases which are still coming through on a daily basis is still very high in absolute terms. But there is hope and light at the end of the tunnel, and clearly that's the vaccine rollout, which we are seeing and which is proceeding apace across the world. Now, clearly different countries are progressing at different speeds. Israel certainly, I think, is at the forefront in terms of the inoculation. But again, it is being slowly rolled out across the world. We're starting to see, not unexpectedly, a little bit of political tension, certainly between, for example, the EU and the UK in terms of, providing supplies and making sure that populations have got access as quickly as various countries want. I think we will always like to run into that situation. Now, clearly, they've got a lot of pharmaceutical companies could and did start pre-producing the vaccines before the approval started to come through. But what we're starting to see now is a lot of that initial stock has been used. And the challenge for the world was always going to be one of logistics in terms of the distribution across the various countries, particularly given that some of these, or a couple of these vaccines do require very cold storage. So again, that was always going to be a challenge. But I think, again, regardless of any sort of bumps that we might get along the road, I think we can take encouragement from the fact that the process is ongoing. And certainly, by the summer, you'd expect that the numbers of people vaccinated will be significantly higher than it is at this moment in time. And all we can hope is that as a result of that, the lockdowns, which many of us are still having to deal with, will have been reduced. One of the fears of the investment markets, or maybe economies as a whole, was that once the vaccine was reduced, people might have been reluctant to get themselves vaccinated. And certainly there was a lot of skepticism across certain countries. So this is just going to give a poll of people who would have been slightly skeptical about taking the vaccine. This is before the first vaccine data came out in October 2020. You can see that countries like France, for example, were quite skeptical. Encouragingly, since the first successful trial data came out at the beginning of November, the people who've been willing to take it has increased as a proportion of the population. And I certainly think, as frontline health workers and the elderly start to get vaccinated, you would hope that those figures that we see here also increase to the extent that most of the population will be willing to be vaccinated. Again, then from an investment perspective, and starting to turn onto the effects of the global economy, what you can do is look at how various countries have both responded to the coronavirus vaccine, and how successfully they've dealt with it. And you can look at tables which are helpfully provided by companies such as Bloomberg, which in this case ranks 53 individual countries, each of which has the size of their economy is over 200 billion, and just see how various countries are dealing with it. Now, again, it brings together a number of measures. It'll bring together a number of new cases and things like universal healthcare coverage, for example. And what's noticeable from that is actually of the top 10, 7 of those top 10 are either in Asia or Australasia. And again, I think that's certainly impacting where we're thinking that we want to be investing in 2021, because otherwise there might have been an assumption that those countries which were hardest hit during the coronavirus pandemic might bounce back most strongly. Actually, we kind of think that those countries which have been at the forefront, which have handled it better than other areas, actually will continue to lead as far as that's concerned. For those of you who are interested in other countries, obviously the UK is about in the middle of the pack at around 30. The US, I think by general acceptance, hasn't handled the situation particularly well. You would hope that with Biden now leading the charge, actually the US's relative ranking there would improve. And actually, of the bottom, on the bottom half really, it's mostly dominated by countries in Latin America. In terms of the economic outlook, again, it's, as we know, and it should be no surprise, 2020 was a difficult year for the global economy, because that's what's happened when you close down large parts of the global economy. But financial markets were very quickly discounted that, and we're looking hopefully to a brighter future in 2021. So if you're looking here at the IMF figures, again, you can see an expectation of economic rebound this year. Interestingly, a couple of days ago, they updated some of their forecasts. And the headline from that is that they expect both the US and China to be the closest towards their sort of pre-pandemic economic peak by sort of 2022. China and the US have handled the pandemic in markedly different ways. China was much more successful in terms of closing down their economy, imposing restrictions for inbound travelers, etc., but hasn't actually provided much or hasn't needed to provide much in terms of fiscal and monetary support. The US has been at the other end of the spectrum. It hasn't handled it particularly well in terms of economic lockdowns, etc., but what they have done is pumped vast trillions of dollars into their economy to try to keep it afloat until such time as we've got the vaccine solution to what is still the medical problem. So again, I think it's reasonable to expect from an economic perspective, US and China will continue to lead the way. Here again, we're just pointing out that I think effectively, as far as what the difference between what we experienced in 2020 and what we experienced in 2008 was the fact that both monetary policy, in terms of interest rates, they were cut quite significantly. Central banks restarted their quantitative easing programs. Again, that's what they did in 2008. The major difference this time was that governments stepped in, and quite frankly, they needed to. Otherwise, the recession would have become even more severe than it was. Even nations such as Germany, which have typically been quite frugal, etc., have pumped in over 35 to 40% of the size of their GDP in terms of those various measures. And again, one of the key messages is that support, as it continues into 2021, will also provide support, we believe, for stock markets and equity markets. And therefore, we're looking for another year of positive returns from stock markets across the world. And this is again just showing in terms of the US, you have stimulus which was put into place, again, about 40% of GDP, so $8.5 trillion. And that's before Biden's new spending plans. Clearly, he wants to put another $1.9 trillion to play. He's unlikely to get that through Congress, but there will be more stimulus coming. Maybe it will be a mere $1 trillion. But again, the support which governments are offering in many cases is not at an end yet. Now, there is a price to pay. That is in terms of the increased indebtedness across the world. In a way, I don't think that's necessarily going to come into play in 2021. That's more of a longer term theme. But again, it's something that we all need to keep an eye on. But if there's one economic figure that, again, I think the market will be focused on most closely, it is inflation. Because as long as inflation is not a problem, the markets will be much more relaxed about central banks and policymakers keeping interest rates at their sort of current levels. And actually, the inflation debate is causing quite a sharp divergence across the investment community, and people have got sharply different views in terms of what might happen to inflation. There are some who believe that actually we are set for a period of much higher inflation moving forward. That's as the economic recovery comes through in 2021. At the same time that governments and central banks are still providing that massive amount of stimulus to the world. We are seeing some supply chain constraints. Maybe we've also seen peak globalization, etc. And maybe there'll be more bringing production back to a sort of local base to make sure that economies don't feel that they're vulnerable to geopolitical tensions or to other countries. And also, again, the labour market is also expected to tighten over the coming months and years. But there are those who also think that actually inflation is not going to be a problem moving forward. Actually, the economy is still going to be quite weak. The labour market, whilst it might improve from where we saw in 2020, is still going to remain below. This unemployment is still going to remain quite high. We've still got the forces of technology and automation acting as a cap on prices. And again, just in terms of demographics, the world is getting older, and those tend to be inflation suppressing forces. So if there's one economic figure that we're going to be keeping a very close eye on moving forward, it is the inflation figure. And this again is just, this highlights either side of the argument, etc. So for those who think inflation will remain restrained, this is look at the unemployment figures in the US. And again, you can see that actually, whilst it's come down from its peak, it is still much higher than we were seeing in 2018 and 2019. And some of that labour market slack will have to be used before we might start to see those inflationary pressures. On the other side of the spectrum, those who think that actually we could be set for a period of much higher inflation will point to the fact that actually, in this sort of environment, there has been a vast increase in savings across the world. Now, some of that has come from some government paychecks, etc., etc. So when the economy does reopen again, there's going to be potentially this massive wave of pent-up demand, which is just waiting to sort of buy new services, go out for meals, buy goods, etc., which is going to feed through to inflation. Now, again, which way those forces eventually play out, yeah, quite frankly, no one has got you can definitively say what's going to happen. But again, that partly explains why people are going to be watching inflation so carefully over the coming weeks and over the coming months. And then we've got a few political developments. Yeah, again, I won't go into this slide other than to say Joe Biden effectively wants to spend more money. He wants to increase areas like climate infrastructure and healthcare, etc. And again, the inflationary repercussions of that need to be considered. And again, whilst we might look at the the change in US president with optimism, etc., I think it would also be somewhat naive to expect that some of the US and Chinese tensions will necessarily go away. They're just going to be dealt with in a slightly different manner with Joe Biden at the helm. But really, in terms of the most interesting things, and again, where we're focusing a lot of time is in terms of the market outlook. So just for the last part of the presentation, I'll just go through a quick few of these slides just to highlight some of the things and some of the issues that we're trying to consider. Again, just going back to Ian's point, 2020 actually, despite everything that happened, turned out to be a good year as far as financial assets were concerned. Very much led by technology stocks, because they were beneficiaries of the working from home and staying at home environment. China and Asia also performed very well, partly driven by their handling of the pandemic and the fact that they were able to reopen their economies at a much earlier stage than many of the Western economies. And also gold performed very well. What didn't perform well, oil. Unsurprisingly, it collapsed in March as a result of the collapse in economic activity. Latin America, because it tends to be quite a commodity sensitive region, and actually also the UK lagged quite meaningfully, which is as a result of its two things. One was the Brexit negotiations, and also the sector composition of the market was not in favour. And that perhaps comes out in terms of the next slide, because it wasn't just where you invested geographically that made a difference. It was the types of stock you were invested in, which also made a big difference. So in an environment where economic growth was quite difficult to come by, investors were prepared to pay ever higher multiples for companies which they felt could continue to deliver growth. So growth stocks outperformed quite meaningfully, particularly in the sales growth area. And again, that's partly explains why technology was such a leader in 2020. And also we saw the situation where the stocks which did well actually continued to do well. The stocks which were out of favour remained out of favour. At the other end of the spectrum, where you didn't want to be invested was in value stocks. So stocks which went into the pandemic as looking like they were offering cheapness, they're offering value, actually continued to lag and actually even got even cheaper. And actually stocks which offered a higher dividend yield in the market were also out of favour, because again, dividends were cut across many sectors and companies, just because back in March, no one had really much visibility in terms of what they could reasonably expect. So in that sort of environment, it's unsurprising that the companies decided to either reduce or eliminate their dividends. And in certain cases, there was also regulatory pressure, particularly in terms of the banks, just to try and to shore up their balance sheets to guard against potential increase in bad loans, etc. So that's where you didn't want to be. I think, again, one of the key messages here is that underperformance that we've seen, certainly from value, will certainly not be as pronounced in 2021. In fact, I think there are good reasons to expect that the value style might come back into favour. And actually, value stocks may well lead the stock market, certainly at various times in 2021. I just want to have a quick run you through quickly in terms of valuations, etc. Because again, one of the most notable things at the moment is that the US stock market is not cheap. That partly reflects the fact that markets rebounded so significantly in 2020 at a time when earnings were under pressure. So if you look at the price earnings ratio of the S&P 500, it's around 23 times at the moment. Historically, that's very expensive. And certainly going back to 1990, the only time the US market has been as expensive was at the peak of the technology bubble in 1999, 2000. Actually, if you're looking at a price to sales ratio, and there's a view that actually price to sales is a better metric to look at because sales can be not manipulated less, but there are less creative things you can do around sales than you might be able to do in terms of earnings. But actually on a price to sales ratio, the S&P 500 is as expensive as it's ever been. Actually, when you bring together various valuation metrics on the US stock market, actually it's registering as pretty much as expensive as it's ever been relative to its history. So that's what's shown on the right hand side. It's a chart we've got from one of our research providers called Stratagas, who look at the various measures, common measures which are available, and just look how expensive the market is trading relative to its own history. The more the box is towards the right hand side, the more expensive it is. You can see in most cases, be it price to sales, be it in terms of last 12 months PE, etc. Pretty much, the market is showing that it is rarely been more expensive. The only measure, pretty much, that you can say that US equities offer value is by reference to interest rates, and particularly sort of longer term interest rates. And clearly that's what's providing the market support at this moment in time. I will say that obviously we've talked about valuations, etc. The point is markets can stay overvalued or in fact undervalued for quite an extended period of time. And again, it would be reasonable to expect actually the US stock market isn't suddenly going to get massively cheaper as long as interest rates and short-term and long-term interest rates remain at their current levels. Short-term interest rates certainly won't be going up anytime soon. And again, that part explains why the market is looking to inflation. Because if inflation starts to accelerate too much, maybe longer term interest rates will start to increase, and that would unsettle stock markets. So it all keys off the inflation and interest rate outlook. We do think the outlook is relatively benign as far as that's concerned, but again, it's something that we need to keep an eye on. Stock market valuations, we talked about the S&P 500, which obviously large cap international companies. If you look at smaller cap companies, actually they're even more expensive. So the Russell 2000, which at the end of 2020 in December offered a PE ratio of about 10,000 times. Since then, it actually hasn't had a PE because of its index constituents has more than offset the profits which are made. The S&P 600 is has more stringent criteria in terms of the companies which can enter it and are part of the index. Even then, it's trading on a PE of 64 times. And there's a lot of talk about stock market bubbles at the moment. And certainly it's right to focus on that, whether it's in terms of the massive outperformance that we've seen in terms of FANG stocks, Facebook's, the Amazons, the Netflix, the Googles, the sheer young age now of companies which are floating on the stock exchange. So the median age of IPOs in the US is only 9 years. And then we've got issues like Tesla and like Bitcoin. And again, if you hold if you're holders of Tesla and Bitcoin, you've done extremely well. The point we're trying to make here is actually maybe a lot of the good news is already in the price. And actually, are they truly based on, certainly in terms of Tesla, is the share price really sort of truly based on reality? Given the fact, Tesla is now by market capitalization, the world's largest car company, despite the fact that it produces just a fraction of the cars that someone like Ford and GM will provide. I'm sure we'll all be driving electric vehicles in sort of 10 years time. But again, this is kind of indicating that actually we're expecting all of those vehicles in a way to come through from Tesla. I think that might be an unrealistic assumption. And again, Bitcoin, it's not something that we'll ever have exposure to within our mandates, just because we believe it's really analyzable, and certainly the volatility we've seen of late is just not something that we would feel comfortable putting in with the into our funds. And again, just again, try to bring some real world examples into that rather than just sort of share prices. This is looking at Tesla over the past 12 months compared to what 3 technology stocks, technology stalwarts, whose names we recognize and who survived the technology boom and bust, and how they performed at the end of the 1990s. And again, you can see that there's been massive outperformance. And just looking over longer term history, I've unfortunately now I can remember, and I was working in the investment world during most of these bubbles and subsequent busts, and again, Bitcoin's appreciation has dwarfed all of them. Government bond yields again has been a longer term trend over the past 30, 40 years, etc. We've been used to an environment where bond yields have continued to decline. Again, I think our general view in terms of this is that we're not expecting bond yields to spike higher. In fact, there's many valid reasons to that they won't do. What we're saying is actually that some of the 30 to 40-year bull market that we've seen in bonds, I think, is coming towards an end, and the sort of reflationary efforts that we're seeing as a result will probably mark that sort of peak in bond markets. But as far as the US stock market is concerned, it's all about corporate earnings. And the good news is that it's an expectation that corporate earnings will continue to increase in 2021. But what we're trying to bring out in this slide is that, again, maybe a lot of the good news has already been discounted as far as stock markets are concerned. Certainly here, if you're looking, the S&P 500 clearly has continued to rise. Corporate profits took a decline and have bounced back. But again, there's a large gap developed, which kind of indicates actually stock markets have moved in advance of that news. So potentially the US might be a relative laggard moving forward. Where we are looking at is in terms of value stocks at the moment. Again, values underperformed not just last year, but for an extended period of time. To the extent now it's underperformed almost as much as it did during that 1999, 2000 period. So we're looking at those areas with a little bit more interest and starting to rotate our portfolios away from those growth areas which have done us so well, and into some of those underperforming value stocks. Partly that reflects 2 reasons. Value stocks tend to do better when the global economic activity has been slow, but is starting to accelerate, which is, I think, realistically what we're seeing at this moment in time. And when we're seeing shorter-term interest rates pinned at current levels, but longer-term interest rates might have an upward bias. And again, both of those situations we believe we're in the midst of at the moment. And again, it's notable that actually what we've circled here is value stocks starting to outperform once the first successful vaccine trial data came through. And we do think that trend has further to continue. We're looking at markets outside of the US. Again, we've performed well, partly on the back of the fact that we've got a meaningful weighting to US equity markets. The US has outperformed for an extended period of time, but if we're starting to see a more cyclical recovery in 2020, areas like Asia and areas like Europe offer a better opportunity to invest in that sort of cyclicality, and also are trading at a cheaper level. And dare I say, we're also just starting to look at the UK equity markets as well. We haven't got any exposure within our diversity and opportunity funds at this moment in time. But again, it's notable how significantly UK equities are starting or have underperformed. We wouldn't be surprised to see perhaps an increase in the M&A, merger and acquisition activity, just as international companies look at the UK market now. They're saying, well, actually the Brexit uncertainty has gone. Actually, UK equities are offering a good value. So maybe there'll be an increase in M&A activity for which the UK equity market may well be a beneficiary. And finally, just in terms of our views in terms of certain assets, the US dollar, we do think it's going to continue to weaken. Typically, it's a counter-cyclical currency. So as the economy accelerates and grows, the dollar typically declines and vice versa. So if the recovery does come through in 2021, I think the trend for the US dollar will be downwards. And also, again, the US dollar feeds off the deficits that it has. And as a result of the massive fiscal stimulus that we've seen, the fiscal deficit is going to increase. There's a big current account deficit. And again, history would tend to lead us to the conclusion that actually the dollar will weaken, which again might be good as far as the gold price is concerned, because gold it trades on the opposite way to effectively the US dollar. So as the dollar weakens, gold strengthens and vice versa. So we've still got some exposure to gold within the diversity and opportunity funds, and we're likely to retain that for the time being. So in summary, just our key messages to leave you with before we open up to the Q&A. Certainly, like, the vaccine is a game changer. I remember speaking during the summer and was saying, obviously, getting a vaccine, discovered, produced, distributed, within sort of the 6 months at the time or by the end of the year was always going to be a massive challenge. Actually, we're pretty much there, which is, again, partly because billions of dollars have been ploughed into that sort of research stream. Monetary policy and certainly fiscal policy is going to remain fully supportive. So therefore, again, that's going to provide, we think, a tailwind for equity markets generally, particularly as policymakers have been at pains to point out, and certainly as far as the US is concerned, that they're going to be in no rush to raise interest rates. And comments from Fed Chairman Jay Powell last night, again, were all about trying to soothe investors and markets' nerves and point out that actually interest rates will remain low. And ultimately, we could be at the beginning of a brand new cycle. And now that we do have a new incumbent in the White House, we would hope that some of those political flashpoints will ease. On the downside, slightly, again, lockdowns are still damaging parts of the global economy. Some of the unemployment that we've seen, which was initially viewed as temporary, is likely to be permanent. So some of that damage is going to take a long time to repair. We still don't know about how long the vaccine will provide protection for. We still think it will provide protection against sort of new mutations, etc. But again, none of us have really had to experience this sort of thing before. So again, it's something that we need to keep an eye on, as is the fact that equity markets have already discounted a lot of good news. We think certain equity markets have discounted more of the good news, but again, certain areas are looking less attractive to us. And markets might get a little bit volatile. Wouldn't be surprised if we do see a bit of a pullback in the January, February time period, just because markets have moved so quickly. And there will be some unsettling, potentially, inflation numbers coming through, which is really just due to base effects. But I think, again, what I'll do is wrap it up by saying, actually, we think the investment environment will remain supportive. We think that stock markets will continue to move higher, but we're starting to shift the focus of our equity investments away from the US and away from growth stocks towards value and towards other areas which we think offer better value. So with that, thank you very much for your attention this afternoon, and I'm very happy to open it up to any questions that there might be. I think I've just had one come through, which I can see on the chat function, which says that given last night's sharp fall in the markets, and it looks likely to happen again today, is this something to worry about, or is it just a short-term opportunity to invest? I certainly think it's the latter. We're not expecting a new bear market to take hold. We are conscious of the fact that markets have moved a long way in a short space of time. There's certain factors such as seasonality to take into consideration. And again, when you're looking at new presidents coming into the White House, very often there's a delayed market reaction to that. So I think it's more of a shorter term nature and a shorter term move. As I said, I think the fundamental position and the fundamental outlook is still one of optimism in terms of the future. So we still expect stock markets to deliver positive returns in 2021. One from Nick: should new investments be used in USD or in Singapore dollars or sterling? What about existing investments in US dollar? Very good question, Nick. I think, as I said, I think the US dollar is likely to weaken, but actually from a portfolio management perspective, a weaker currency gives us opportunity to deliver currency appreciation by actually diversifying outside of the US dollar. So actually, how we'll react to our expectations of dollar weakness is to, again, looking at areas like Asia, like Europe, potentially like even the UK, because again, we think we can get a currency tailwind as far as that's concerned. I think sterling again is going to remain a very difficult currency to call. It has bounced back quite significantly, given that there wasn't that ultimately hard Brexit. But actually, I think so sterling could be relatively well bid, I think, in the coming weeks, because again, a lot of the bad news had already been priced in, and actually some of that bad news didn't come through. So again, currencies are always a very difficult one to call. I think from our US dollar base, the fact that we're based in US dollars isn't providing any issues to us. In fact, it's going to provide opportunities to make sort of more of a currency, more currency gains moving forward. But clearly, again, that's where you have to take into your account your individual, your individual circumstances. What I'll probably do, as there's no further questions, just very quickly go through. Ian was very kindly highlighted at the beginning of the slides, at the beginning of the presentation, just our fund performance during 2020, which we're very satisfied with. This just brings out all the numbers in terms of diversity fund, which, as we know, is a more of a balanced type of approach. Again, as Ian highlighted, we made 14.4% during 2020, well in excess of the benchmark peer group in this case, and building on a strong 2019 as well. So that now we're seeing that the 1 year, the 3 year, and the 5 year numbers, and certainly the numbers since inception, are looking very strong relative to our peer groups. In terms of opportunity fund, again, very strong performance in 2020 as we were able to take advantage of some of those tailwinds that we saw in terms of the US equity stock market's outperformance, in terms of tech, etc. So very pleased that in terms of the opportunity fund, we managed to deliver a return which is ahead of the world index, and again over whether it be 3 months, 6 months, 1 year, 3 year, 5 years. Actually, our numbers are well ahead now of the international peer group. And the good thing about these funds is that we do have a very long-term track record. The Opportunity Fund was launched in April 2001, and you can see from the annualized figure there, during that time we produced an annualized return of over 8% compared to a return from the MSCI World Equity Index of 6.5% and the peer group of 4%. So very much both Mark and I, Mark Piper, who manages the Opportunity Fund, and me, who manages the Diversity Fund, have worked together for pretty much for 20 years or so. We've been through these various periods before, as I talked about when we talked about the bubble slides, etc. Sadly, I now have experienced most of those firsthand. So again, I would hope you take some comfort from the fact that the situations that we've dealt ourselves in, we've got the experience of having gone through these sort of issues before. Nothing's quite the same. I hadn't gone through a global pandemic clearly before. But what we like to do is make sure that we're trying to build on the relative experience of the team. And I apologise, I just realised that the slides weren't up because I stopped sharing my screen. So I'll just quickly go through those. Hopefully you can see those now. Again, just to point out the numbers, and we can circulate all these slides to you later on. Again, they're just talking about Diversity Fund, the 14.4% for 2020, and again, longer term outperformance of the peer group. And in terms of opportunity fund, the 17.2% return in 2020, and actually over the longer term, we've delivered an annualized return of 8.3%. So with that, I will stop sharing my screen now. Are there any other questions? Yeah. Ian, is there anything you want to add?
Hi, Justin. Thank you very much for that. I think you've covered everything. If there are any other questions from any, I can still see there's over nearly 30 participants. So if anyone does have a question, you can just hit the Q&A button at the bottom and type away. If not, obviously we'll send out the recording to everyone, and also some slides and any information you need. Just please feel free to contact us, and hopefully the strategies will continue to do well. And I think we've heard lots of reasons why they should, and why they should also do well relative to the stock markets as well. So any questions, you can hit Q&A. Otherwise, I think that's it. We'll call it an evening. No? Okay. Okay, well, thank you very much, Nick and Justin. That was very useful. And yeah, we'll get another update at another time for everyone. Okay, thank you, everyone. Good evening.
Thank you very much.